Good morning. It's Friday, the 4th of October, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. Now, there were many reasons proffered and offered for what could turn overheated stock markets eventually, and war figured somewhere but was not top of the list. And we're almost there now. Stock markets across the world have turned distinctly nervous now, ranging from Asia and Europe to, of course, Wall Street. On Thursday, Indian indices were down quite sharply in their worst session in 2 months, around 2%, more than many other markets. Elsewhere, oil prices are rising, currencies are under pressure, and even gold prices, which also usually rise along with war tensions as investors migrate to safer assets, are also falling. And there's more. The biggest dockworker strike at major US ports in some 50 years stretched into its third day, stopping unloading of ships. West Coast ports are functioning, but ships will have to sail around the Panama Canal to reach there. Now, all of this obviously adds to the problems already afflicting commodity and merchandise exports and imports, as the case may be. Like before, India is not insulated against global market movements. Oil prices are still around $75 a barrel, though it could be worse. But the fact that it is not is more worrisome in some ways, as it reflects the perception that demand for oil in major economies from the United States to China is shrinking, and more on that shortly. All of this is not good news in the longer term because a global slowdown, if it happens, is something that's going to affect all countries and economies. October 7th will be the first anniversary of the terror attack by Hamas against Israel. A year on, hostilities have only increased even as a low-intensity war has raged for many, many months now. While the world at large, including the financial and oil markets, had to some extent isolated the tensions in this part of the Middle East, that may no longer be possible. Particularly if Israel retaliates against Iran's latest missile attack. Given Israel's track record of going for the aggressive and ignoring international pleas, it would be best to brace for the worst. For India, the only thing going for it at this point is, of course, the domestic economy, including strong monsoons, which will provide much-needed relief to the agricultural economy and boost rural consumption. On the other hand, China is pulling capital away. Reuters reports that stock brokerage Jefferies, for example, has increased its China weightage in its Asia-Pacific ex-Japan portfolio and reduced its India weightage. There is one perhaps silver lining to all of this. Indian stock markets, by most accounts, have been overvalued and stretched and needed some correction. That this present correction is coming via external triggers and not internal is perhaps the only good news I can see. And that brings us to the top stories and themes of the day. The stock markets crash around 1,800 points. Could they fall further? Will retail investors sustain this beating? Hyundai's 25,000 crore initial public offer is poised for launch. Oil prices are rising as traders brace for full-scale attacks. And the mid and affordable segment house sales fall further, but expensive houses rise.
This is a Core Report with Govindraj Ethiraj.
Markets crash. Stock markets worldwide sank as tensions in the Middle East ratcheted up in the last 48 hours. Eurozone stocks were down, as were stocks in Asia Pacific, particularly shares outside Japan, which bucked the trend. Several markets, including mainland China and South Korea, were actually closed on Thursday. On Wall Street, markets fell marginally overnight as they continued to show nervousness as traders watched the Middle East for further cues. Back home, the BSE Sensex closed down 1,769 points to end at 82,497, while the Nifty 50 broke the 25,300 mark to close at 25,250, down 547 points. This was the third biggest decline for the Sensex this year. As a recap, the Sensex has fallen by about 1,000 points or more on 7 other occasions in 2024. The Thursday fall was the third largest of 2024, the Economic Times said, adding that on June 4th, the Sensex had fallen, as you will all remember, about 4,390 points when the general election results were announced. On August 5th, the Sensex had fallen 2,223 points, that being the second biggest decline. One reason markets are falling is the selling by foreign investors, who, according to some analysts, have sold over 15,000 crore rupees in the last 2 trading sessions. Some of that has moved or is moving to China. Elsewhere, new regulations have kicked in to control speculation in derivatives and futures and options. Those regulations were moved by the Securities and Exchange Board of India. The new rules include increasing the contract size or tripling it from 5 lakh rupees to 15 lakh rupees. That's also raising margin requirements and mandating the upfront collection of options premiums from buyers. I reached out to veteran market analyst Ambareesh Baliga and I began by asking him how he was looking at the correction that had set in the markets, the reasons for it, and how that could affect investors. And I also asked him about the impact of the new futures and options rules.
So, see, if you look at market internally, everything seemed to be going extremely well in the last many months. I would say the last 2 to 3 years, especially post COVID. Basically, the markets were moving up because the liquidity was available and the sentiments were extremely good. And because of which the liquidity was there flowing into the markets, getting out of FDs flowing into the markets. I mean, they're having a number of red flags, but the markets were, in fact, ignoring all that because as long as you're making money, you're putting in more money. So it was a virtuous cycle which was there. It needed an external, event to break that cycle. And none of the events so far have been extremely strong to really break that cycle. I mean, it had put a temporary stop. I mean, whenever we have heard of geopolitical issues, the markets have reacted negatively. But within 2 or 3 days, we realized that it is more localized and it's not in our backyard. So the markets have again bounced back, and that's happening globally. This time, I think the fear is that possibly, it could extend, it could get worse, and because of which we have seen this fall. But even as of now, we are not sure whether it will get worse or not. I mean, that's the sort of expectation which is there in the market, because of which we have seen this correction. Now, this correction, if you look at Nifty, it's about 1,000 points from the top, which is approximately about 3% or so, 3.5%. So, even as of now, you can't be too sure that this will extend. Now, in case we see that extension happening and markets lose possibly another 1,500 points, that's the time we need to see as to what happens to the financiers of the market. And the financiers of this market are retail investors. And for them, possibly this would be the first time they would be seeing a decently large fall because most of them are post-COVID. They've seen one-way market. So in case they start panicking, because the other thing I would like to say is in the last 3 to 4 weeks, we have seen new highs for the market, but most of the retail portfolios are not performing. In fact, they were, staring at losses, and losses are slowly increasing. So right now, if that panic happens, in case, like I said, in case we see another 1,000 fall on the Nifty, in case we see panic, all this sentiment and liquidity which we've been talking about will actually vanish. And when that vanishes, you can expect a further fall. So I think this is what we need to wait and watch out for. Possibly post that, decide what to do. Again, the larger picture, longer term picture, you really can't go wrong on India, assuming that we still continue to have a stable political atmosphere here. You really can't go wrong in India. So in case we see a panic, I would say that's an opportunity.
The other conjoined factor is the new regulations on futures and options, where SEBI has come out with a series of regulations. And they include, for example, more intraday monitoring of positions and primarily increasing the contract size from 5 to 15 lakhs. So tripling the contract size, raising margin requirements, and also mandating upfront collection of options premium from buyers. So what is all of this adding up to in your assessment?
No, I think it is high time that they did this, because right through we've been seeing that most of these traders, and I would say most of them are fairly new to the markets.
And that's something the data is showing itself. They're new and they're losing money. Yeah.
Exactly. And like continuously losing money. I don't think anyone is really asking as to where this money is coming from. Because most of them are small traders, like retail investors. So I would say investors, retail traders, I would say. And this money is coming from their pocket. So either it is fixed deposits. Now, once the fixed deposits are over, and because of which also we have seen a lot of fixed deposits getting withdrawn from the banks, post that it is personal loans. Personal loans have been increasing quite sharply, and especially gold loans. Again, we have heard RBI governor being a bit worried about gold loan increase. I don't think the worry is from the gold financing company's point of view because they are completely secured. But I think there is a systemic issue out here because typically you take gold loans, especially as a last resort. My fear is that a lot of personal loans and a lot of gold loans have been taken to finance these losses. Needs to see as to where we land up because figures are huge. We are talking of those 3.5% top loss makers. 4 lakh traders losing 28 lakhs per person. Just look at the figure. And basically, where is this money gone? F&O is a zero-sum game.
Yeah, it's mostly the big traders with trading with algorithms who've taken it. Yeah.
Exactly. And those are large guys, maybe institutions, quite a few other institutions. So the money has gone out from the retail into larger pockets.
Right. Okay, so let me come back to the secondary markets. Now, one of the things you've been, for instance, consistently pointing out is the parts of the market which have clearly been stretched. For example, some PSU stocks, defense stocks, and such categories of stocks. Do you think that this kind of a correction that we're seeing right now could see some positive rebalancing? And if so, what could that lead to?
Yeah, there would be positive rebalancing because I would still see that these sectors, especially you're talking about defense, railways, PSUs, especially all the sectors which had become multi-baggers, I think you'll see some sort of a further correction because, again, talking about defense, these stocks were more or less 10 to 15 baggers in the last 3 years. Now, a 15 bagger losing 30% is nothing much, which is about 4.5x of the original like valuation. So even if it falls there, the 25-30%, still, those who have been sitting on it for the last 3-4 years still are making good money. But with the other fall of 25-30%, at least the valuation will become decent. So, I would see still a further fall for most of these stocks.
So, investors at this point of time, what are you telling investors in particularly, let's say, the mid-size or maybe even the larger ones? And how should they be looking at this market right now?
No, like I said, I really don't know whether, this is the beginning of the fall. I think over the next 2-3 days, we should have more clarity. And I was suggesting people to be, to an extent in cash. That figure was close to about 40% for most of my clients and subscribers. With this sort of a fall, I would say, don't clearly sit on the sidelines. Since you're sitting on that much of cash, maybe invest 2 or 3% of that 40%. Because in case of a good bounce back, at least you make some money there. But in case the markets fall further, we are still sitting on a pile of cash which can be invested.
Right. Ambareesh, thank you so much for joining me.
Thank you.
And before we continue, a short break. If you're a small business, here's a useful announcement. Did you know that Google Maps, Google Search, and Google Pay can help you reach more customers and much faster? The Core Report invites you to hear top Google leaders tell you how to leverage new features from the Google tech stack. Join us at the Google India SMB or Small and Medium Business Summit at the Leela Ambience at Gurgaon today. So go to the link in the description and register right now. And yes, of course, it's free to join. And now, back to the show. Oil prices are inching up. Oil prices are moving up once again as the markets assess whether there could be an actual hit on Iranian oil infrastructure, and more on that shortly. Brent crude crossed $75 per barrel, while West Texas Intermediate topped $72 a barrel, with both benchmarks rising nearly 5% in the last 3 days, according to Reuters. India has been preparing for lower oil prices, or has been geared for lower oil prices, with several references to a potential cut in prices at the petrol pump, which may or may not happen now. Reuters reported that gold prices too have come down as the US economic data tempered expectations of an aggressive rate cut in November. Spot gold was down slightly at about $2,645 per ounce after hitting a record high of $2,685 last week. So there is no big impact of war tensions on gold prices yet. So where could oil prices go, and what are the key factors playing here? I reached out to Bjarne Schieldrop, Chief Analyst Commodities of Oslo-based energy research firm SEB. I began by asking Bjarne, connecting with me from London, how he was seeing the Middle East factor affecting oil prices right now.
So the first instance where Iran and Israel shot directly at each other, it was in April this year. And before that, they had always just been shooting at each other through proxies, in Syria, via Lebanon and so on. But now, and that Pandora's box has been opened yet again. So now Iran recently shot at Israel, and we know that Israel will retaliate. And everyone knows it's going to happen. And I think most likely it's going to happen within 5 days, probably before Monday, 7 October, which was 1 year ago when Israel were attacked by Hamas. And no one knows exactly how forceful the attack from Israel will be. The sense is that Israel has a very high level of confidence following success in Lebanon, and that they might feel superior and actually go hard in. And I think that is making the market very, very nervous. Because if Israel this time around retaliates heavily versus the retaliation in April, which was kind of feeble, just to show that they can and not really aiming to damage, they might actually aim to damage some part of Iranian infrastructure of different levels. Many choices to pick from. But if they go hard, then Iran again is forced to retaliate yet again. And that is the escalatory tit for tat situation which the market is very concerned about.
Right. So, two situations. I mean, one is that Iran's physical infrastructure takes a hit, and Iran produces about 3 million barrels per day. And what's the potential fallout there? The other is that even if, let's say, there is no infrastructure hit and there's no direct attack, the tensions that are now at a higher level, what is that likely to do to oil prices or any other thing that might happen?
So oil price bottomed out earlier in September at $68.68 per barrel. That was the low point in September. And now we are up at $75, $76. So it's not a big increase. And that gain is so far, it's two things. Risk premium for what might happen, and also short covering among speculators who have been selling a lot of oil and has to buy back, and thus forcing the price back up because they don't want to sit short if it happens. So if you look at the different targets which Israel could hit in Iran, it's oil facilities, yes, and Iran is producing a lot of oil and it's exporting around 2 million barrels per day. So if Israel went heavy-handed and actually damaged all of that infrastructure and capacity to export like 2 million barrels per day, which I think is very hard to do because it's a big infrastructure. It's not so easy to take all that oil infrastructure out in one go. But if they did, then OPEC Plus has a spare capacity of 5 to 6 million barrels per day at hand. And Saudi Arabia alone can easily lift production by 2 million barrels per day. So the world is not going short oil even if we lose all of Iran. But spare capacity would be lowered dramatically from current 5 to 6 to instead 3 to 4. So a smaller cushion would be left for flexibility on the supply side. And if that happened, market would be extremely concerned that the next level could be some development that involves the Strait of Hormuz currently exporting some 18 to 20 million barrels of oil into the global market, or around 20% of global supply. And the market started fearing some kind of disruption in that flow would add a significant risk premium. I mean, if you look at the current price of like $75, $76, so yet the market is not very concerned about the Strait of Hormuz being disrupted, or really not a high level of concern that all of Iranian exports will be damaged either. But it's definitely a big level of uncertainty of what is going to go down in the coming 5 days from Israeli retaliation toward Iran.
Right. And how are you seeing trends on the demand side and at this particular point of time? And to what extent is that keeping prices down?
That is, of course, has been the big story for 2024, has been the very weak Chinese oil imports and consumption, and also weak economies in OECD. So we haven't had much of any strong impulse on the demand side, except for a few emerging markets around in the world, or patchy global demand. So I think we still have the same situation. Yes, we've got the stimulus package in China, but that is basically aimed at preventing the economy from faltering further rather than to boost it massively. It's a backstop rather than a bazooka growth story. So I don't think that demand is anything to be extraordinarily happy about. But right now, it's all about concerns for what is going down in the Middle East, the biggest source of oil in the world, that is sort of capturing the market, capturing the oil price. But the demand side is still weak and soft and nothing to be celebrating.
Right, Bjorn, thank you so much for joining me.
Thank you very much. Have a nice evening.
Hyundai's giant IPO. Hyundai Motor India, the Indian subsidiary of South Korean automaker Hyundai, is all set to go ahead with its much awaited 25,000 crore initial share sale for public subscription on October 14th. Business Standard quoting wire agency said this would be the largest IPO or initial public offer in India after LIC's initial share sale of 21,000 crore rupees. According to the draft Red Herring Prospectus or DRHP filed in June, Hyundai's proposed IPO is an entirely offer for sale by promoter Hyundai Motor Company with no fresh issue component. In those draft papers, Hyundai Motors said it expects that the listing of shares will enhance its visibility and brand image and provide liquidity and a public market for the shares. As we've been pointing out, there are not too many MNCs who actually listed in India in recent years. Hyundai launched in India in 1996 and sells about 13 models, mostly SUVs, across segments. And the primary market is experiencing, of course, as you know, heightened activities. This year, 62 companies have already raised about 64,000 crores via the main board, as it's called, marking a 29% increase from about 49,000 crores last year and 57 firms in 2023. While markets would welcome Hyundai and such IPOs for their badge and balance sheet quality, the size of the IPO is also worrying at this time, given the markets are already weak right now and could stay so for some time. It would be interesting to see if Hyundai goes ahead as planned and how the pricing plays out. Rice all the way. In other markets, rice prices fell the most in more than 16 years in Asia as concerns over supply eased after India relaxed export restrictions and allowed exports of rice, according to Bloomberg. Officials the core report spoke to at the All India Rice Exporters Association earlier this week had said that they were expecting rice prices globally to fall as India, which represents close to 45% of global rice trade, re-entered the market. Thai white rice 5% broken and Asian benchmark fell about 11% to $509 a ton on Wednesday, according to the Thai Rice Exporters Association quoted by Bloomberg. This was the biggest decline in data compiled since May 2008 and extended a prolonged slide in prices to the lowest level in more than 15 months. And according to Bloomberg, which also added that rice is vital to the diets of billions and contributes as much as 60% of the total calorie intake for people in parts of Southeast Asia and Africa. However, while rice prices have cooled, the cost of other food staples are rising as extreme weather threatens harvest around the world, said Bloomberg. Mid and affordable segment house sales are falling while expensive ones are rising. India's residential sector witnessed another robust quarter across the leading 8 residential markets, according to real estate consulting firm Knight Frank. In the third quarter of 2024, that's the calendar year, home sales grew about 5% year on year to about 87,000 units. Now, this brings residential sales to about 260,000 units in the first 9 months of 2024. That's about 9% higher than the same period or the first 9 months of last year calendar. Mumbai leads the race with sales of about 24,000 units, making this the best recorded quarterly sales volume since 2018, says Knight Frank. Now, here's where the divergence starts. Home sales in ticket sizes of 1 crore rupees and above continue to grow. However, the share of sales in mid-size has moderated while the affordable segment continues to shrink or go down. And this perhaps explains or rather points to the fact that we've been discussing for some time, which is that affordability at the lower end, whether it's for cars or houses, is falling or has fallen. Residential prices grew the most in Bangalore at about 10% year on year. The National Capital Region, which is the region around Delhi, was the only residential market to see a decline. Though for the past 13 quarters, high-end properties in the National Capital Region have consistently moved up and have represented about 46% of all sales for the third quarter, up from a year ago. So the National Capital Region is the only residential market to show a degrowth of 7% in sales. Now, this market has also historically been amongst the more speculative markets, says Knight Frank, with a relatively higher quantum of investment interest. Broadly, of course, if one were to take a step back, the residential markets for real estate continue to look strong, though more at the top end. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.